Ever looked at your trading history and wondered how someone who understands the rules keeps breaking them? You know what you're supposed to do. You know what not to do. And yet, there you are again. Same mistake, same explanation, different day. This chapter is not about fixing your entries. It's not about finding better confirmation. It's about asking a question most traders avoid until it's too late. Are you trying to win, or are you trying to survive? Because those are not the same thing. Most traders come into the market with a silent assumption that trading is about being right, about growth, about proving intelligence, discipline, potential. But the market doesn't reward potential. It doesn't care how hard you studied. It doesn't respect intention. The market only responds to behavior under pressure. And this is where things quietly break. If you're listening to this, you're probably not reckless. You're not ignorant. You're not lazy. You're emotionally aware, but behaviorally inconsistent. That's not a character flaw. That's a nervous system problem. Trading is one of the few environments where uncertainty, risk, reward, and identity collide in real time. Every decision carries consequence. Every outcome feels personal. Your brain did not evolve for this. Under uncertainty, the human brain doesn't optimize for long-term survival. It optimizes for short-term relief. Relief from fear, relief from regret, relief from the discomfort of not knowing. So when you overtrade, you're not being disciplined. You're seeking relief. When you hesitate on a valid setup, you're not being cautious. You're protecting identity. When you chase after a missed move, it's not greed. It's the brain responding to perceived loss of opportunity as if it were physical pain. This is where most traders misdiagnose themselves. They think the problem is motivation, or confidence, or discipline. But discipline doesn't disappear randomly. It collapses under emotional load. And the first emotional load every trader faces is the pressure to win instead of the need to survive. Survival sounds boring. Winning sounds exciting. But every trader you admire eventually made the shift, not publicly, internally. Jesse Livermore didn't lose his fortunes because he didn't understand markets. He lost them because emotional conviction slowly replaced emotional containment. He believed more strongly when he should have risked less. He pressed when survival demanded restraint. That's not ignorance. That's identity overriding regulation. And this is where the survival question becomes uncomfortable. If you strip away profits, losses, streaks, and outcomes, can you survive your own decision-making process? Because long-term trading survival isn't about avoiding losses. Losses are inevitable. It's about avoiding emotional spirals. The spiral after a loss. The spiral after a win. The spiral after boredom. The spiral after confidence. Most traders don't blow accounts on one bad trade. They bleed out through a sequence of emotionally justified decisions. One exception becomes a habit. One override becomes permission. One just this time becomes identity. Your brain is constantly asking a question you're not aware of. How do I feel right now? And then it finds a trade that matches the answer. If you feel anxious, it looks for certainty. If you feel confident, it looks for expansion. If you feel behind, it looks for acceleration. This is not conscious sabotage. This is pattern completion. The mind hates open loops. Unresolved emotion feels like danger. So it resolves emotion through action. That's why surviving in trading is psychological before it's technical. Before risk rules, before position sizing, before performance metrics. Because rules don't enforce themselves, and systems don't execute without a regulated operator. Here's the quiet realization most traders never articulate. The market doesn't end careers. Unregulated emotional decisions do. Once you see trading as a survival environment, your priorities change. You stop asking, how much can I make? You start asking, what state am I trading from? You stop asking, was this a good trade? You start asking, was I stable when I placed it? This shift doesn't make you passive, it makes you precise. Survival doesn't mean fear, it means containment. It means creating conditions where your worst tendencies can't express themselves unchecked. And here's the most important reassurance in this chapter. If you're inconsistent, you're not broken. Your brain is doing exactly what it evolved to do under uncertainty and reward. The mistake is expecting willpower to override biology. Long-term traders don't have stronger discipline. They have fewer emotional decisions. They reduce exposure not just to market risk, but to internal volatility. They build environments, rules, and identities that make emotional collapse harder. That's the framework we're moving toward. Not fixing you, structuring around you. Before we move on, ask yourself this honestly. When was the last time you stopped trading, not because of rules, but because you sensed internal instability? Most traders wait for damage before they stop. Survivors stop before the damage begins. By the end of this audiobook, you won't just understand why you struggle. You'll recognize the moment struggle begins. And that awareness changes everything. Because the next question isn't about markets at all. It's about why intelligent traders still self-destruct when pressure builds. And that's where we go next. Ever looked at a losing streak and thought, I knew better than this? You read the books. You've watched the interviews. You can explain risk, probability, discipline, patience, cleanly, intelligently. So here's the uncomfortable question. If knowledge is enough, why are you still here? This chapter isn't about intelligence. It's about why intelligence collapses under pressure. Because the market doesn't challenge what you know, it challenges how your brain behaves when uncertainty becomes personal. And this is where smart traders quietly self-destruct. You don't fall apart because you're careless. You fall apart because your brain is overloaded. Trading is a constant stream of decisions with incomplete information. No clear feedback loop, no certainty, no finish line. Every trade forces your mind to hold risk, expectation, fear, and hope at the same time. That's not a skill problem, that's a cognitive stress test. When cognitive load rises, the brain looks for shortcuts, not better logic, relief. This is where discipline gets overwritten, not by laziness, by chemistry. Every win releases dopamine, not happiness, anticipation. Dopamine doesn't reward success, it rewards possibility. So after a win, your brain doesn't say, good job, slow down. It says, there might be more. After a loss, it doesn't say, regroup. It says, fix this, now. This is why smart traders overtrade, not because they forget rules, but because dopamine narrows focus. The mind stops asking, is this aligned, and starts asking, what if? What if this one works? What if I miss the move? What if I can make it back faster? Under pressure, intelligence doesn't disappear, it gets hijacked. You start using logic to justify emotion instead of regulate it. That's the subtle danger. You don't feel impulsive, you feel rational. You can explain every decision, you can defend every click. And that's exactly how self-destruction stays invisible. Look at the traders who implode dramatically. They're rarely uninformed, they're overloaded. Jesse Livermore didn't blow up because he didn't understand markets. He blew up because conviction amplified emotion, and emotion drowned restraint. Confidence without containment is not strength, it's acceleration. And acceleration feels incredible. Until it isn't. Here's the pattern you may recognize. You start the day calm, focused, disciplined. Then a trade goes against you. Not disastrously, just enough to irritate. Your attention narrows. Your breathing changes. Your internal dialogue speeds up. Now you're trading and monitoring your self-image at the same time. That's cognitive overload. The brain cannot hold high emotional arousal and long-term planning simultaneously. One will dominate. Usually it's the one that reduces discomfort fastest. So you trade again and again. Not to make money, to stabilize emotion. This is why saying just be disciplined doesn't work. Discipline is a prefrontal function. Stress activates deeper systems. When stress rises, the thinking brain goes offline. You don't lose control suddenly, you lose it gradually. One exception, one stretch, one internal promise you'll tighten up later. Smart traders don't fail loudly. They negotiate themselves into failure. And the most dangerous part? You still feel smart while it's happening. You're explaining, rationalizing, forecasting. But the real driver is chemical urgency. Here's a question most traders avoid. If your strategy is solid, why does your behavior change with emotional state? The answer isn't lack of rules, it's lack of emotional buffering. Professionals don't eliminate emotion, they limit its range. They don't rely on discipline, they reduce decision density. Fewer trades, clearer conditions, stricter exits, not for the market, but for themselves. This is the reframing. Smart traders don't self-destruct because they don't know better. They self-destruct because knowing better doesn't regulate dopamine. Awareness doesn't stop chemical loops. Structure does. And until you understand this, you'll keep blaming yourself. You'll think you're flawed, undisciplined, inconsistent. You're not. You're unprotected. Here's the quiet shift that changes everything. The goal is not to trade well when you feel good. Anyone can do that. The goal is to remain operational when you don't. That requires fewer decisions, not more analysis. Clearer boundaries, not stronger motivation. Let me ask you something uncomfortable. When was the last time you stopped trading because you noticed cognitive overload, not because you hit a limit? Most traders notice after damage. Survivors notice before. That's the difference. By the end of this chapter, you should understand this clearly. Your intelligence is not the solution. It's neutral. Without structure, intelligence accelerates emotion. With structure, it channels it. And the next step isn't adding more rules. It's understanding what actually happens in the brain under risk. Because once you see how fear and reward physically shape decisions, you stop taking your behavior personally. And that's where real control begins. That's where we're going next. Ever noticed how calm logic disappears the moment real money is on the line? Not slowly, not politely, it vanishes. One moment you're objective, the next your finger is hovering, your chest is tight, and your mind is loud. This chapter is about why that happens, not metaphorically, biologically. Because the market doesn't just test your strategy, it activates ancient systems in your brain that were never designed for financial risk. And until you understand that, you'll keep blaming yourself for reactions that are not personal failures. They're neurological responses. When you place a trade, your brain doesn't see numbers. It sees threat and reward, uncertainty. And uncertainty is the fastest way to wake up the amygdala. The amygdala is not rational. It doesn't calculate probability. It scans for danger. Its job is simple: detect risk, trigger action. That's it. When price moves against you, even slightly, the amygdala fires. Heart rate changes, breathing tightens, attention narrows. This happens before conscious thought. By the time you say, "I should stay disciplined," your nervous system is already active. This is the first misunderstanding traders have. They think fear and greed are emotions they choose. They're not. They're automatic survival signals. The amygdala doesn't care about your rules. It cares about immediate protection or opportunity. Protection feels like hesitation. Opportunity feels like urgency. That's fear and greed at the biological level. Now let's talk about the part of you that knows better, the prefrontal cortex. This is the area responsible for planning, impulse control, and long-term thinking. This is where discipline lives. But here's the part most traders don't realize. The prefrontal cortex is slow, energy expensive, and fragile under stress. When stress hormones like cortisol increase, prefrontal activity decreases. This isn't philosophy, it's chemistry. Under pressure, the thinking brain weakens, the reactive brain takes over. That's why you don't forget your rules. You lose access to the part of the brain that enforces them. This is why telling yourself to stay calm rarely works. You're asking the weakest system to overpower the strongest one, after the strongest one is already active. And then comes dopamine. Dopamine is misunderstood. It's not pleasure, it's anticipation. It spikes when there is possibility. After a win, dopamine rises, not to reward discipline, but to signal potential future reward. This is why winning can be more dangerous than losing. Your brain starts projecting forward. What if the next one works too? What if today is different? What if I press just a little? This is not arrogance, it's neurochemistry. Paul Tudor Jones once said that the most important rule in trading is defense. Not because he lacked confidence, but because he understood internal volatility. Professionals don't trust their brains under risk. They design around them. Now think about what happens during a loss. Cortisol increases, stress rises, the body prepares to fix the problem. Your attention narrows to one goal, resolution. That's why revenge trading feels urgent. It's not emotional immaturity, it's the brain seeking to close an open threat loop.
Loss feels unresolved. The brain wants closure. Action promises closure, so you act. Not to make money, to stop the discomfort. This is the loop. Amygdala detects threat or opportunity. Stress or dopamine rises. Prefrontal control weakens. Action feels necessary. And afterward, you explain it. This is where traders get confused. They think explanation equals control. It doesn't. Explanation happens after the fact. Awareness doesn't stop the loop immediately, but it changes your relationship to it. Here's the reframing. You are not the emotion. You are the observer of a system generating emotion. That distance matters. Because the moment you notice, I feel urgency, instead of, I need to act, the prefrontal cortex begins to re-engage. Awareness slows reaction. Not perfectly, not instantly, but enough. Enough to create space. And space is where survival lives. This is why long-term traders aren't emotionless. They're emotionally literate. They recognize internal signals as data, not commands. Fear becomes information. Greed becomes information. Neither becomes instruction. Jesse Livermore struggled because his conviction fused identity with market direction. When emotion and identity merge, regulation collapses. The market wasn't just testing his positions, it was testing who he believed he was. That's when brains under risk fail hardest, when outcomes define identity. Here's a question worth asking. When you feel compelled to act, is it because the situation changed or because your internal state did? Most traders never separate those two. They assume urgency means opportunity or danger. But urgency is just arousal. The market doesn't shout. Your nervous system does. And here's the most practical realization in this chapter. You don't need to eliminate emotional reactions. You need to delay obedience to them. A few seconds, a breath, a a pause. That pause is not weakness, it's neurological leverage. The moment you pause, cortisol begins to level. The prefrontal cortex regains influence. This is not mindfulness talk, this is regulation. Survival depends on it. Because without regulation, your intelligence becomes a weapon against you. It rationalizes urgency, it defends impulsivity. It explains behavior that should have been interrupted. The goal isn't to trade without fear. That's impossible. The goal is to notice fear before it becomes action. By the end of this chapter, you should understand something most traders never realize. Your biggest edge is not prediction, it's regulation. And regulation doesn't start with rules. It starts with recognizing when your brain is no longer neutral. In the next chapter, we're going to go deeper, because once you understand how the brain reacts under risk, the next uncomfortable truth appears. You're not just managing trades, you're protecting an identity. And that changes everything.
Ever held a losing position longer than you planned? Not because the market told you to, but because closing it felt like admitting something about yourself. That hesitation wasn't about money, it was about identity. This chapter is about the quiet force behind most trading mistakes. Not fear, not greed, self-image. You don't trade the market as it is, you trade the market as it reflects back who you think you are. And that's where survival starts to fail. Most traders believe they're protecting capital. They're not. They're protecting identity. The identity of being smart, disciplined, capable, right. That identity is fragile under uncertainty because every trade carries an unspoken question. What does this outcome say about me? When a trade works, identity expands. When it doesn't, identity contracts. And the brain treats identity threat more seriously than financial loss. This isn't metaphor, it's psychology. Threats to self-image activate the same stress pathways as physical danger. Your nervous system doesn't distinguish between losing money and losing status. So when a trade goes against you, the reaction isn't just disappointment, it's defense. Defense looks like holding too long. It looks like moving stops mentally. It looks like just give it a little more room. Not because you believe in the trade, but because you're resisting what closing it would mean. I was wrong. That sentence is heavier than it sounds. For many traders, being wrong doesn't mean a bad decision, it means a bad self. And that's where risk management collapses. You already know how to manage risk, you just don't when identity is on the line. This is why smart traders sabotage themselves quietly. They don't panic, they don't rage, they negotiate. They tell themselves stories that protect ego while exposing capital. This is just noise. My read is still valid. The market is irrational. Sometimes that's true. Often it's identity preservation masquerading as analysis. Jesse Livermore struggled with this deeply. His greatest strength, conviction, became his greatest weakness when it fused with identity. When being right became who he was, not just what he did. At that point, exiting a position wasn't a tactical decision, it was a personal one. And personal decisions under risk are rarely clean. Here's the uncomfortable truth. The market doesn't care who you think you are, but your brain does. So it will bend behavior to protect self-image. That's why post-win overconfidence is dangerous. After a series of wins, identity inflates. You don't just feel confident, you feel validated. Now risk feels smaller. Rules feel flexible. You trust yourself more than the framework. Not because you're arrogant, but because success temporarily quiets self-doubt. And quiet self-doubt feels like mastery, until it doesn't. Then there's the opposite side. After losses, identity contracts. You start trading to repair self-image. You want to feel competent again, capable again, in control again. So you take trades that promise emotional repair, not statistical edge. This is revenge trading at the identity level, not anger, restoration. The brain wants to feel whole again, and the fastest way to feel whole is to be right, even once. So you trade to win back belief, not money. This is why telling traders to detach from outcomes doesn't work. Identity doesn't detach on command. It detaches through structure, through redefining what success actually means. Here's the reframing that changes everything. Long-term traders don't identify as people who are right. They identify as people who are aligned. Aligned with process, aligned with risk, aligned with self-awareness. Being wrong doesn't threaten them. Being unregulated does. This shift is subtle but powerful. When identity is tied to execution quality instead of outcomes, losses stop feeling personal. They become data, and data doesn't need defending. Ask yourself this honestly. When you review a bad trade, are you looking to understand it or to excuse it? One leads to survival, the other leads to repetition. Identity wants comfort. Survival demands clarity. This doesn't mean ego disappears. It means ego is put in its place. Professional traders don't eliminate ego. They limit its jurisdiction. Ego doesn't decide risk. It doesn't decide size. It doesn't decide when to stop. Those decisions are pre-made. Because the moment identity is allowed to negotiate with risk, risk loses. Here's a grounding question. If nobody ever saw your results, if no one judged your intelligence, how would you trade differently? That version of you is closer to survival than you think, because identity pressure fades when performance isn't performative. You stop trading to prove, you start trading to execute, and execution is quieter than ego. By the end of this chapter, you should understand something most traders never realize. You don't break rules because you lack discipline. You break them because the rules threaten who you think you are in that moment. Fix the identity pressure, and behavior follows. In the next chapter, we're going to talk about discipline in a way most traders misunderstand, not as willpower, not as character, but as structure that removes identity from decision-making. Because survival doesn't require you to be better, it requires you to be protected from yourself.
Ever tell yourself, just one more trade, then I'll stop? And somehow, hours later, you're still there, tired, irritated, disconnected from the version of you that started the day. This chapter is about that moment. Not the trade itself, the moment you lose the ability to stop. Because overtrading isn't about opportunity. It's about being caught inside a loop. And once that loop starts, logic becomes background noise. Let's be clear about something right away. Overtrading is not excitement. It's fatigue. Most traders imagine overtrading as impulsive, reckless behavior. That's not how it actually feels. It feels focused, intentional, urgent. You're not chasing randomly. You're trying to fix something. And that's what makes it dangerous. The cycle usually begins quietly. A loss that shouldn't matter, but does. A missed opportunity that lingers longer than it should. A win that raises expectation instead of satisfaction. Each one adds weight. Not enough to stop you, enough to load you. This is emotional residue, stress that hasn't been resolved. The brain doesn't like unresolved states. It wants closure. And trading offers the illusion of closure. One more trade could fix it. One more trade could validate you. One more trade could put things back in balance. So you act, not because it's a good decision, but because action feels like relief. This is loss recovery urgency, the moment where your goal quietly shifts. You're no longer trading the market, you're trading your internal state. And the more tired you become, the harder it is to notice. Emotional fatigue doesn't announce itself. It disguises itself as determination. I'm locked in. I'm not quitting like this. I know I can read this. But fatigue narrows perception. You stop seeing the whole environment. You start seeing only what confirms action. This is why overtrading often accelerates after losses. Cortisol rises. Attention tightens. Your nervous system goes into repair mode. The brain interprets loss as a problem that needs immediate resolution. Waiting feels like failure. Stepping away feels irresponsible. So you stay. and the loop tightens. Jesse Livermore experienced this repeatedly. After losses, he would trade aggressively, not out of anger, but out of a need to reassert control. The market didn't just challenge his positions, it challenged his sense of mastery. And mastery, once threatened, demands restoration. That's the core of revenge trading. Not rage, restoration. The need to feel competent again. This is where traders misunderstand themselves. They think, I'm emotional. What they really are is unresolved. Emotion that isn't processed looks for expression. Trading becomes that expression. You click to release tension. You enter to escape discomfort. You stay because stopping would force you to feel what you're avoiding. Here's the hard part. Overtrading doesn't stop because you decide to stop. It stops when the loop is interrupted. And interruption must happen early. Once emotional fatigue crosses a threshold, your ability to self-regulate drops sharply. This is not weakness, it's physiology. The brain, under prolonged stress, loses sensitivity to long-term consequences. All it wants is immediate relief. That's why promising yourself to do better next time doesn't work. The promise is made by a calm version of you. The violation is carried out by a fatigued one. Different operators. So the question becomes, how do you interrupt the cycle before it takes over? Not with motivation, with recognition. The earliest sign of overtrading is not increased activity, it's internal urgency. A feeling that something needs to happen. A pressure to participate, a discomfort with stillness. That feeling is your signal, not to trade, to stop. This is where practical control lives. When you notice urgency, you don't analyze it, you don't argue with it, you create distance. You stand up, you physically step away, you break the sensory loop. Not as punishment, as containment. Because once urgency is embodied, tight chest, shallow breath, narrowed focus, cognitive control is already compromised. Pausing feels counterintuitive in that moment, because the brain equates stopping with loss. But stopping is not loss, it's prevention. Here's a reflection worth sitting with. Do you usually stop trading because the session is over, or because you're emotionally complete? Most traders stop when forced. Survivors stop when they notice internal instability. That's the difference. Over time, interruption becomes easier, not because the urge disappears, but because you trust yourself to respond to it correctly. You stop fearing the feeling, you recognize it, and recognition reduces its power. This is how overtrading loses its grip, not through control, but through early awareness and enforced distance. One more important realization. Overtrading feeds on identity, the need to be active, the need to prove resilience, the need to finish strong. Letting a day end unresolved feels like weakness, but it isn't. It's maturity. Markets don't reset your emotions for you. You have to do that yourself, and that requires tolerating discomfort without acting on it. That skill, staying present without fixing, is one of the most valuable survival traits a trader can develop. Because the market will always offer another chance to act, but it rarely offers a chance to recover from emotional spirals. By the end of this chapter, you should understand something most traders never realize. Overtrading is not a trading problem. It's an emotional processing problem. Fix the processing, and the behavior changes naturally. In the next chapter, we're going to examine something even subtler, how fear and greed disguise themselves as logic, and why traders often feel most in control right before they lose it.
Ever felt certain you were making the right move, only to look back and realize the feeling that drove you was fear in disguise? Or confidence that wasn't confidence at all, but greed pretending to be control? This chapter is about those moments, when emotion masquerades as rational thought, when fear wears the mask of caution, and greed wears the mask of clarity. Most traders believe they act rationally under pressure, that the decisions they defend so passionately are purely logical. They are not. They are emotional responses dressed up in reasoning. Consider Jesse Livermore, one of the most brilliant traders in history. He could read markets with uncanny precision, yet he blew up multiple times. Not because he lacked skill, Because he trusted conviction without containment. He let emotion dictate how much he risked, and each time he paid the price. Fear in trading doesn't scream, it whispers. It tells you to wait, to hesitate, to be cautious. You nod, thinking you're disciplined. You justify every delay, every exit, every hesitation. But beneath it, the nervous system is signaling threat, not analysis. Greed behaves similarly. It doesn't roar. It convinces you that you are in control. It tells you to hold just a little longer, to stretch one more position, to trust your read. You listen because the feeling is seductive. Confidence feels like control, and control feels necessary. But the truth is, control is an illusion. Even the best traders, Livermore included, experienced it. Markets can humble conviction in seconds. And when greed and fear are running the show, conviction is no longer your ally. Let's dissect this further. Fear disguised as caution slows you down. It makes you miss opportunities that align with your plan. It makes you overanalyze. It makes you trade defensively. Greed disguised as confidence speeds you up. It makes you stretch risk beyond comfort. It makes rules negotiable. It pushes you to act when inaction would be smarter. The danger is that both feel like rational choices. You justify, you rationalize, you explain. And in doing so, you fail to notice that emotion has already taken the wheel. Here's the core pattern you may recognize. After a loss, fear tells you, wait for certainty. After a win, greed tells you, double down, you're right. Your behavior changes, but your internal explanation remains constant. I'm just being careful. I'm just confident. Sound familiar? Now the subtle shift begins when you start noticing the signals before they dictate behavior. The tightening chest, the racing thoughts, the compulsion to act to prove yourself, the hesitation to act to avoid being wrong. These are the moments when fear and greed are strongest, and when containment is possible. Containment doesn't suppress emotion. It doesn't argue with it. It simply observes it. You acknowledge this urge is coming from emotion, not the market. That pause, just a few seconds, is enough to regain perspective. This is what Livermore learned too late. Brilliance without psychological containment is fragile. Emotion is relentless. Markets are indifferent. So what does this mean practically? First, every conviction must be vetted internally. Ask yourself, am I acting because the market presents an opportunity or because my emotional state demands action? Second, implement constraints. Hard limits on size, duration, and exposure reduce the ability for greed to escalate. Boundaries are not punishment, they are protection. Third, cultivate awareness of subtle internal cues. The tightening chest, the pressure to fix a loss, the compulsion to stretch a winning streak. These are your early warning signals. The market will always offer new information, but it cannot protect you from your own emotional machinery. Here's a reflection to consider. If fear and greed were fully honest with you, what would they reveal about your current trades? Would you still act the same way, or would you step back and observe? The most dangerous moments in trading are rarely loud. They are quiet, seductive, and justified, and they are when survival is most at risk. By the end of this chapter, you should understand something most traders never realize. Conviction is meaningless without containment. Confidence without observation is greed in disguise. Caution without recognition is fear in disguise. The market doesn't punish skill. It punishes uncontained emotion masquerading as skill. In the next chapter, we'll explore the subtle patterns that keep traders repeating these cycles and how awareness alone can begin to weaken their control. Ever wondered why some traders survive decades
while others disappear after a few losses. It isn't just skill. It isn't just strategy. It's how they relate to risk. This chapter is about seeing risk differently, not as math, not as probability, but as a psychological anchor. Most traders think risk is external, something imposed by the market, a number to calculate. That's only half the story. The other half is internal. Risk exists inside your nervous system, inside your decision-making circuits, inside your identity. Every trade you take carries two kinds of risk: financial risk, the numbers on the screen, and psychological risk, the potential for your emotions to hijack you. The second is far more dangerous. Paul Tudor Jones built one of the greatest trading careers in history. He didn't just define risk limits to protect capital, he defined them to protect himself, to stabilize his mind under pressure. Because when drawdowns arrive, and they always do, emotion escalates faster than the market moves. Fear rises, greed tempts, ego whispers that rules can bend. Without psychological anchors, these responses overpower reason. Without them, even the best strategies fail. Here's the key insight. Risk management is the framework that stops your brain from hijacking trades. Not by preventing loss, by preventing loss of control. Every stop, every size limit, every structural rule is a tether. It reminds your nervous system that action is bounded, that survival is possible, that you are not at the mercy of every impulse. This reframing matters because the brain interprets financial loss as threat. Amygdala spikes, stress hormones surge, cognitive control weakens. The market doesn't care that the position is within risk parameters. Your body does, and if your system feels threatened, rational rules lose authority. That's why experienced traders treat risk limits like a psychological scaffold. Consider this. If you know that a loss will never exceed a fixed amount, your mind can remain present. Your focus shifts from fear to execution. You can act according to plan instead of reacting to emotion. This is the anchor, a consistent reference point that stabilizes your decisions. The contrast is stark when you look at traders who ignore it. One unexpected loss triggers panic. Next, overtrading, then revenge trading, finally, emotional breakdown. Numbers are meaningless without the psychological framework to interpret them. Now, let's think about drawdowns. Most traders fear them because they feel personal, but Paul Tudor Jones approached them differently. A drawdown was not a failure, it was feedback. It was a test of discipline and composure. He knew the market would always offer opportunities, but the only thing he could control was his mind. That mindset reframes risk entirely. It stops being a metric of how much I can lose and starts being a guide for how steady can I remain. This is subtle but powerful. When your psychology is anchored, you trade differently. You don't overreact to a loss. You don't chase wins. You follow process. You execute. Anchored traders see the market clearly because internal turbulence is minimized. Ask yourself this. Do your current risk rules protect capital or protect your mind from hijack? Most traders focus on the first. Survivors focus on the second. The distinction is what keeps you trading another day, another week, another decade. This isn't theoretical. Every system, every stop, every limit serves dual purposes. It protects equity, and it protects emotional stability. And when the two are aligned, performance becomes consistent, not because of luck, but because the mind no longer undermines itself. This is the ultimate leverage in trading. Not the market, not the strategy, your own mind, stabilized by clearly defined psychological anchors. By the end of this chapter, you should understand something most traders never realize. Risk isn't just about losing money. It's about surviving your own impulses. It's about creating a framework where fear and greed no longer control your decisions. In the next chapter, we'll explore how long-term survival depends on integrating these psychological insights into daily execution so that consistency becomes a habit, not a struggle.
Ever wonder why some traders seem untouchable by losses, overtrading, or emotional swings? It's not talent. It's not luck. It's a mental framework designed to survive where others fail. This chapter is about building that framework, a repeatable, reliable operating system for your mind, one that aligns identity, rules, and emotional awareness into a structure that actually supports long-term performance. Let's start with identity. Most traders operate from fractured identities. They trade to prove themselves, to avoid shame, to feel competent in a market that doesn't care about self-image. When identity is tied to outcomes, every loss feels catastrophic. Every drawdown becomes personal. Every missed opportunity triggers doubt. The first step in building a survivor's framework is separating self-worth from results. You are not your P&L. You are not your winning streak. You are not your mistakes. You are the observer, the executor, the consistent presence that endures beyond the immediate market noise. Next, rules. Rules are often treated as optional, advisory, suggestions. That's dangerous. In a survivor's framework, rules are anchors. They prevent emotion from hijacking behavior. They remove the burden of willpower. They create structure when fatigue, greed, or fear would otherwise push you off course. Rules are not punishment. They are scaffolding. They tell your nervous system, here's where you are safe. Here is where you can act with clarity. Now, emotional awareness. You cannot ignore what rises inside you during trading. The urge to act impulsively, the tightness in your chest after a loss, the subtle overconfidence after a win. Emotional awareness is not about suppression, it's about recognition, naming the impulse, observing it, and choosing whether it aligns with your rules and long-term goals. This triad, identity, rules, emotional awareness, is the core of a survivor's framework. Let's connect it to real-world behavior. Imagine you've just experienced a drawdown. Most traders panic. They either overtrade to recover or retreat and freeze. A survivor reacts differently. First, they notice the emotional state. Second, they confirm that it doesn't dictate action. Third, they execute only what the rules allow. Notice the difference. It's subtle. It's not flashy. It doesn't feel like genius, but it works. This is also where repetition matters. A mental framework is useless if applied sporadically. Survivors apply it consistently, regardless of market conditions or emotional intensity. It becomes automatic. The system guides behavior, not raw emotion. Think about Jesse Livermore or Paul Tudor Jones. Their brilliance was not just market insight, it was consistent mental architecture, boundaries, awareness, and detachment. They survived drawdowns that would destroy less disciplined traders. Here's a reflection to consider. How often do you trade from impulse versus framework? How often do you let emotion decide risk, size, or entry? What would change if each action was filtered through a system designed to protect both capital and mental state? The survivor's framework is not theoretical. It has 3 layers. Identity. You trade as an observer, not as someone proving self-worth. Rules. Non-negotiable limits and protocols that guide every decision. Emotional awareness. Recognizing impulses before they dictate behavior. Applied together, they form a single operating system, a mental OS that ensures decisions are consistent, sustainable, and resilient under stress. This framework also allows for adaptation. Markets change, emotions fluctuate, but the operating system remains stable. It filters the noise. It dampens volatility in decision-making. It prevents temporary impulses from creating permanent losses. Let's be honest. You've probably tried to trade discipline before, but without a framework, it relied on willpower. And willpower fails under fatigue, stress, and excitement. A mental framework doesn't fail because it's not relying on you to be perfect. It relies on structure, observation, integration. Ask yourself this: are your trades currently guided by a repeatable mental system or by fluctuating feelings, fragmented identity, and occasional reminders to stay disciplined? If it's the latter, you've already identified the gap. The goal is not perfection. The goal is survival, consistency, long-term presence in the market. By the end of this chapter, you should understand something most traders never realize. Survival isn't about reacting correctly to every market move. It's about designing a mental system where reactions are automatically contained, identity is stable, and emotion is acknowledged without hijacking behavior. In the next chapter, we will explore how to integrate this framework into daily execution so that consistency becomes not an aspiration, but a natural outcome of how you operate. Ever caught yourself thinking, if I just make this trade right, everything will be okay? That thought feels urgent, necessary, real. But trading is rarely about a single outcome. It's not a sprint. It's a long conversation with yourself. Every decision, every pause, every exit or hold, it's a line in that ongoing dialogue. A dialogue that stretches across minutes, hours, days, even years. Most traders approach the market as a series of battles: win or lose, right or wrong, success or failure. That mindset creates tension, pressure, the constant tug of fear and greed. The truth is, the market doesn't care about your outcomes. It responds to your psychology, your ability to survive the mental demands, your capacity to stay consistent under uncertainty. Consider Paul Tudor Jones, who often framed trading as a conversation with himself rather than the market. Each trade was feedback, not verdict. Each win or loss a note in a long-running discussion about patience, discipline, and self-awareness. Here's the subtle shift most traders miss. When you see trading as a conversation rather than a scoreboard, your relationship with emotion changes. Fear is no longer a signal of failure, it's information. Greed isn't a reason to overreach, it's insight into how the mind responds to reward. Every impulse, hesitation, or compulsion is part of the conversation. You can acknowledge it, respond to it, and then continue. This perspective reframes your identity. You are not the sum of your trades. You are the participant in this ongoing dialogue. You are the one who observes, reflects, and acts deliberately. Jesse Livermore, brilliant yet flawed, understood this at times, but often too late. His greatest wins came when he listened to himself. His losses escalated when he ignored the dialogue, letting ego and impulse dominate. Now imagine your trading day as a series of messages from yourself. One trade triggers frustration, another triggers confidence. You notice, you observe, and you respond with awareness. No judgment, no self-punishment, just a conversation. The goal is process loyalty, not outcome obsession. Loyalty to rules, loyalty to emotional awareness, loyalty to identity that isn't defined by immediate results. This is the essence of long-term survival. Ask yourself, do you chase outcomes to prove something to the market or to prove something to yourself? Do you react impulsively, hoping the market will validate you, or do you respond deliberately, letting the conversation unfold? Most traders never notice the distinction, and it's the distinction that separates survivors from the rest. Process loyalty allows you to withstand volatility. It allows you to maintain clarity under pressure. It allows you to return to the conversation every day, regardless of wins or losses. Because the conversation never ends. It's continuous, it's cumulative, and it's where true mastery lies. Here's a practical reflection. Before each session, ask yourself, what is my role in today's conversation? Am I here to prove, to win, or to observe and act responsibly? During the session, monitor the dialogue. Notice fear, greed, or impatience. Name them. Respond according to your framework. After the session, review the conversation. What patterns emerged? What did you learn about your mind, your identity, and your resilience? Trading as a long conversation shifts focus from control to awareness, from outcome to process, from proving yourself to understanding yourself. This approach doesn't remove losses, it doesn't guarantee wins, but it dramatically increases the likelihood of survival, of consistency, of sustainable performance over time. By the end of this chapter, you should understand something most traders never realize. Trading success is not built on perfect execution. It is built on continuous self-dialogue, on observing impulses, on respecting emotion without being dominated by it, on committing to survival as the foundation of every decision. The conversation is ongoing. The opportunity to practice, reflect, and adjust is unlimited. And that, more than any single trade, is what keeps you in the market long enough to succeed.